We now have a dynamic version of both the aggregate supply side, represented by the Phillips curve and Okun's law, as well as a dynamic version of the aggregate demand side, represented by monetary policy alone. In some sense, this brings us full circle to those very first descriptions of the aggregate economy you have encountered in your principles class, and that is the circular flow diagram. I hope you worked your way here step by step, since the final result will otherwise seem ad hoc. If any of the components seem confusing to you, review the discussion of aggregate supply and/or aggregate demand, or of course, feel free to reach out to me at any point. First things first, Okun's law represents the relationship between changes in the unemployment rate and the output gap. If the economy is growing above potential growth, unemployment will fall and vice versa. For instance, in the past few years, potential growth in the US is estimated to be around 2.1%. Now, when the economy was growing at 3% in 2010, unemployment fell rapidly. Last year, we were closer to 2% in terms of actual growth, and unemployment by and large stayed flat. That is what Okun's law illustrates. Now, it is early to say what 2020 will bring, but most economists predict a contraction of at least 2% over the year. Potentially a contraction of 20 to 30% in the second quarter due to these COVID-19 related shutdowns. And this is a dramatic contraction. There's really nothing like this in modern history. According to Okun's law and any sort of data you will see, this will cause the unemployment rate to jump up dramatically. Estimates for the second quarter currently lie around 10%, although personally I wouldn't be surprised if we do not breach through this ceiling in the coming months. So that's definitely a realistic number to expect, and it is very much in line with what Okun's law is suggesting. Second, the accelerationist Phillips curve reflects the relationship between unemployment and inflation. If the unemployment rate is below zero, nominal wage growth will increase, accelerating inflation, and vice versa. As discussed earlier, this relationship is empirically wonkier, in part because expected inflation has dropped over the past 10 years. Further narrow is not observable, we have to estimate it. Currently, most economists place narrow at around 5% or slightly below that, meaning that about 3.7% unemployment last year in 2019, wage pressures started to mount. For reasons that we discussed previously, inflation in 2009 was a little bit lower than the Fed's target of 2%. It was about 1.5% by the end. But at the same time, wages kept growing pretty steadily throughout the year. Now, what to make of the modified Phillips curve is a little bit up to debate, and I'm not going to get into that too much here. Just be aware that this link is weaker than it once was. We certainly still saw some inflation and some wage pressures as the unemployment rate fell as much over the past 2 years. But based on our expectations going into the current expansion, or this last expansion, I should say, we would have expected more inflation than we actually saw. Finally, number 3, aggregate demand links output growth to money growth minus inflation. Again, this link in practice is weaker than the simple specification suggests because the stimulating effect of money growth is lower at the lower zero bound in a liquidity trip scenario, as lenders may not pass on any monetary stimulus in actual credit. Now, for our purpose, and going back to theory a little bit, keep in mind that each of these equations is endogenous to the others, and that's why this is a circular flow logic. For instance, as changes in the labor market depend on the output gap, which in turn responds to changes in aggregate demand. If, for instance, the Fed accelerates GMT, accelerates money growth, it can to some degree affect the unemployment rate. Money growth translates into higher current growth that, should all else things the same, increase the output gap, which will cause unemployment to fall. As a matter of fact, that is actually one of the mandates the Fed has, and this is what we talk about when you hear this sort of full employment mandate. That's precisely the channel this references. However, at the same time, tighter labor markets, based on the Phillips curve, also tend to have an upwards pressure, create an upwards pressure in inflation, because tighter labor markets translate into higher nominal wages. Now, as inflation tends to accelerate, it tends to dampen demand again. right? So we come full circle no matter where we change anything here. Now, discussing how the economy behaves then in the short run and the medium run, and trying to put sort of timing discussions on this, is easier to start with the implied medium run behavior first, because the medium run really is our equilibrium that we're always gravitating towards to. The medium run equilibrium, ignoring business cycle things, is characterized, one, by unemployment that's equal to the natural level of unemployment, which in turn implies that the unemployment rate does not change over time. UT minus 1 is equal to 0. If the unemployment rate does not change, Okun's law implies that growth needs to equal potential growth. Right? That's the second aspect here. In practice, one can estimate potential growth this way, although economists typically don't do it that way. We'll come back to this relationship later. Finally, the modified Phillips curve implies that inflation needs to be constant. This, of course, is true by definition. Narrow is the unemployment rate for which inflation is not accelerating nor decelerating. That implies inflation is constant. On the demand side, growth needs to correspond to potential output, G by bar, right? That follows from the other two equations. That's simply the supply side. And that needs to be equal to some value of long-term money growth, which we'll just call GM bar here. That's set by the Fed, minus inflation. Now, solving for inflation gives us a long-term prescriptive path, or really descriptive path, I should say, how inflation behaves over time. Inflation in the medium run long term is equal to money growth minus potential growth. Now, what does this mean? This is a standard, somewhat monetarist interpretation of inflation. If you're interested in monetarism, read up on it. I'm not going to teach it because it's not something that economists really consider relevant anymore. However, the intuition here is relatively straightforward. If money growth in the medium long run equals exactly real potential growth, that is the growth path of the economy, additional money will exactly match additional transactions demand. And in that case, inflation will be equal to 0. It will not cause any inflation because there isn't more money than there's actual demand for money. If money growth is faster than potential growth, it causes inflation. And because inflation is the norm, this is something that central banks actually do. The money supply grows faster than output, specifically to cause some inflation. The idea here, we're trying to discourage deflation. We're trying to get people not to hold on to money, but for instance, instead buy bonds, put money in their 401k, buy stocks. And so there's a policy choice. Meanwhile, if money growth is slower than potential growth, it can cause deflation. Again, keep in mind that this link has weakened in the context of the lower zero bound because money growth isn't as stimulating as it once was. It cannot create the same increase in aggregate demand if lenders do not pass on lower interest rates to borrowers. Now notice, and this is the main takeaway here, that an increase in the money supply, not any increase in the money supply, will cause inflation. Only increases in money growth, that is the change in money, that are A, in excess of potential growth, and B, pass on an actual stimulus to aggregate demand, will cause inflation. And in the medium run, it will cause inflation alone. Now, this rate of change thinking is what economists usually mean when they speak of the super neutrality of money instead of just the neutrality of money we discussed earlier. But it doesn't really qualitatively mean anything else. Money over longer periods of time doesn't affect anything other than the inflation rate. The reason why we're having this discussion is that the money supply keeps growing in any given year, and this static view of thinking about aggregate supply and aggregate demand, as the simple text model suggests, is a bit inaccurate. Rather, we have to think about where we at compared relative to our potential growth path. Now, that said, be careful to not take a mechanistic approach to understanding money growth and inflation. That I hear a lot. This idea that money growth leads to inflation one by one. That's clearly not always the case, and it clearly hasn't been the case over the past 10 years, where money growth has accelerated while inflation actually has decelerated. We've seen a faster increase in money supply where we've seen a slower increase in prices. So the one-by-one relationship between money growth and inflation is something that simply doesn't hold. Money growth will only act inflationary if it can create demand. Now, over the past decade, we built up the money supply a lot. But because lenders didn't pass on the stimulus as much, because interest rates are this low, it actually did not translate into dramatically more demand, and hence it could not translate possibly into dramatically higher inflation. Now, finally, I will provide a slightly longer practice problem to illustrate what's going on in the short run that you can work through. Intuitively, it's not really that different from what you've seen in aggregate supply, aggregate demand before, so let me just summarize the process quickly at this point. If we start in our medium run equilibrium, that is at potential growth and the natural level of unemployment, an expansionary monetary policy action, that is increasing money growth, will stimulate aggregate demand in the near term, pushing growth above potential or normal growth, positive output gap. Okun's law then implies that a positive output gap will reduce unemployment. Unemployment starts falling. Finally, number 3, from the modified Phillips curve, unemployment below the natural level predicts accelerating inflation. And this accelerating inflation is what then pushes us back to the natural level over time. Now, a couple of takeaways. 1, because inflation will accelerate if the economy grows above potential for too long, a stable permanent trade-off between unemployment and inflation cannot exist. So that puts a pin into the discussion we had last week. Second, when it comes to money, this is true for fiscal policy as well, timing is everything. To control inflation, central banks have to throttle money growth and raise interest rates when the economy is growing above potential for too long. That is one of the reasons why the Fed monitors labor markets closely, and when the unemployment rate falls far enough, the Fed will start increasing interest rates to dampen demand. This is what we call offsetting overheating sometimes. Now, this is in line with its objective of generating price stability, which is its primary objective traditionally, and not so much with this idea of creating full employment, the way that we perhaps intuitively think about it, unless you define full employment as narrow, in which case sometimes the unemployment rate falls so low that the Fed actually wants to increase it, and that it does by increasing interest rates in an effort to control inflation. Similarly, when you're on the other side, when you're in a recession, if the economy drops below potential, and this is obviously the case currently, in which we effectively have shut down broad segments of production really in this country, and especially in areas like leisure hospitality, as you know. The Fed has to increase money growth, not only because it wants to help labor markets, it certainly does that, but also because it risks deflation if it doesn't. And deflation makes recessions worse. Right? It tends to reduce demand further because it creates an incentive to hold money instead of investing in, say, a firm or even government. Finally, the overall relationship between inflation and money growth, and again, this is critical in the current environment we live in, relies heavily on money's potential to stimulate demand in the short run. Now, it's not clear to which central banks can really do this when interest rates are zero, as I've mentioned many times by now. Now, in this slide, if you look at what the Fed currently did, which was this strong expansion of credit to all sorts of financial intermediaries, not just banks, but commercial lenders, to mortgage lenders, to even municipal borrowers, really a very, very broad segment of the financial system. These measures really do not serve so much as to stimulate the economy. The objective here is more to keep the credit system functioning, what the Fed calls keep credit flowing in the economy. And the effort or the intention here is to keep those alive who have mortgage payments they need to make, who have potential student loan payments they need to make, who have to make, for instance, small business loans while the economy is shut down. So this isn't so much a stimulus in the traditional sense. This is more an effort to keep the economy from shutting down further because people can temporarily no longer pay off their loans. That would reduce aggregate demand even more. It is, however, less clear to which degree the Fed's action can actually stimulate demand. Now, offsetting reduced demand by households who have lost a large number of jobs, again, we're talking the millions range here, and firms who have lost basically all their revenue stream short term, saying that I'm on the verge of bankruptcy is simply not something a monetary stimulus can plausibly address. That will require swift and presumably larger fiscal policy action we've already seen. Now, Congress passed the CARES Act, that's about $2 trillion. They're still working on dispersing this, but given the magnitude of this crisis, most in the profession, most economists expect that there will be further stimulus down the road. That's where it needs to come from. That's not something a central bank can do, so just that you can put the current measures by the Fed a little bit in context. As I said, I will talk a little bit more about this on Thursday, but that's it on the medium run. There's a lot of material here. Once we're done with this, once the exam is passed, we will move towards the long run. The long run then basically starts from scratch. We'll go back to something that looks much more like microeconomics. So in many ways, these dynamic versions of aggregate supply, aggregate demand are the hardest discussions we'll have in this class. I know there's a lot of stuff in this material. If you do have any questions, tune in on Thursday. If this is past Thursday, then well, obviously that ship has sailed. Shoot me an email. I'm happy to